Hi, I'm Scott Schubert with Trading Mastermind, and today I'm going to show you the very most important breakthrough that you will ever make in how to read financial markets. Let's get started with that right now. Okay, when you're introduced to the trading world, you may have had a lot of training in the past and come across different courses, educational material. You may have read books, gone to seminars. You may have had different mentors and so forth that are designed to help you to learn to trade. And in this process, your attention will be taken to different types of things. Some of it may have something to do with how to read the market, and unfortunately, a lot of it has nothing to do with how to actually read the market in a way that would enable you to make a trading decision that would turn out to be profitable. The first thing that you would need to know in order to read any financial market, and once you learn to read financial markets, you can use it for commodities, for stocks, for Forex, for cryptocurrencies, for any kind of financial market. The first thing you would need to know how to do is to recognize the difference between what is known as impulsive price action versus corrective price action. And this concept goes beyond Elliott Wave. It goes beyond what is commonly taught in the industry as price action trading. And the first thing is that you will notice that the market is making movements in one direction, and then it seems to pause and turn and make a movement in the opposite direction. And there are key characteristics of these two types of price action. So the first thing is that during the impulsive price action, interesting thing happens. Like, this is an actual trend of the pound versus the kiwi on the daily time frame, and this is a very good example of strong impulsive price action. So if you first learn what's called Elliott Wave, you will receive the instruction or guidance that during a trend, like in an uptrend, the market is making higher highs and higher lows and waves that don't overlap. So that's what we have here is higher highs and higher lows and waves that don't overlap. So this wave does not come anywhere near overlapping into this range of price. And it's not just that there are higher highs and higher lows and waves that don't overlap, but much more than that. There's a very distinct shape to the whole thing. The angle of it, the proportion of the waves, all of it become very clear and very obvious. Then during a correction may form lower highs and lower lows in a correction to an uptrend and waves that overlap. So these waves are overlapping right here. Even more important and more obvious than all of this is that impulsive price action, you will see, first of all, during a downtrend, all of the candles are closing toward their lows. So that makes long-bodied candles, and all of these are closing close to the low. Another very important aspect of this is that during the impulsive price action, what's happening is that the market is moving great amount of price, a large amount of price, more amount of price than it does during the correction over a short period of time. And what does that actually do? That's what creates what we know as angle. And for the engineers who are always eager to get some kind of a tool to measure the angles are not absolute in trading, because on your charts you can easily change the angle. See, I'm just drastically changing the angle, and this will change according to what time frame I'm looking at, whether I'm zoomed in or zoomed out. But there is kind of a standard default view of looking at charts, and when you're looking at charts all the time, you will notice that there is an angle, and a trend is moving a larger amount of price over a shorter period of time, and that causes a steeper angle. Then, during the time when it is correcting, it will move a smaller amount of price over a longer period of time, causing a lower angle, less steep. The obvious part of this would look like this. Here it's moving really strong in a short amount of time. Then it pauses and it just goes sideways to slightly down, and it takes a longer period of time for it to move during the corrective part of it. And it will only move a percentage of the amount that it moved in the impulsive price action. In this recent trend of the euro versus the Kiwi, depending on what kind of, I can change the, because I have two channels below this, that's going to change the angle right there. But you'll see that it moved all of this amount of price over a short period of time. And then it moved only 23% of that amount of price over a longer period of time, creating a different angle, a different shape. So you can tell, once you learn how to read this, you can tell the difference in the shape of impulsive price action, or what we know as trends, and corrective price action. Soon this will just become obvious to you. The trend has an angle, looks like this. The correction might move a longer period of time and a shorter amount of price, or a shorter amount of price over a longer period of time, and end up looking something like that. And then it will take off again and continue the angle. And since this is what markets do, this is what any trader who wants to make money from trading should become aware of right in the very beginning, like the first day that you look at charts. You would want to become very much aware of this. None of the other stuff really makes that much difference if you can tell where is the impulsive price action, where does it begin, and where does it end? Where is the corrective price action? Where does it begin and where does it end? If you can identify those things, the whole world, the whole door of the market will open to you, so that you can just harvest profit from the market over and over and over. Think about it. Look at charts and see that this is true. First thing you want to do is realize that that's true. See if you can see any clues about how might you identify that there's impulsive price action. What stage of development is it now in? Is it about to end? When it ends, how would you be able to identify that it has ended? And then when it forms a correction, how can you tell that it's forming a correction? Corrective price action, impulsive versus corrective price action. Can you tell if it's doing that? And then can you tell if it's ending? If you can tell those things, you can trade and trade and trade and have excellent results in any market condition, on any kind of instrument, any currency pair. So this really is the key to how to read any financial market. And in the next video, we will go deeper into how can you tell if the market is forming impulsive price action from the very beginning, not after it has done it. After it has formed impulsive price action or after it has formed a trend, it's time to exit. So a lot of people, they see all this impulsive price action on their charts and they think it's a good market to enter, and what they're actually doing is entering at the end of the trend, because when you see it, you should be looking for an exit. This is probably more than I should be revealing in this short video, but think about this, look at some charts, and let me know in your comments if this is becoming apparent to you as you look at charts. Is it becoming clear that that's true? Are you realizing that it's true? If so, you may be on your way to total success in trading. If you want to find out what really works in trading any market, go to tradingmastermind.com.